Nobody told you this was happening. Nobody sent you an invoice. Nobody sat you down and explained that the cost of a war being fought thousands of miles away had just arrived in your grocery cart. Your utility bill, your Amazon checkout page. You felt it. You noticed the numbers. But you couldn't see where it was coming from because the mechanism that moved the cost from a missile strike in the Red Sea to your wallet, it is completely invisible. And it was designed that way. This is not a story about oil prices. It is a story about something far more subtle. A financial transmission system buried inside the global trade network. One that starts with a percentage point on an insurance contract and ends with inflation that nobody can fully explain. And once you understand how it flows, you'll never look at a price tag the same way again. Here's the question that nobody asks because the answer seems too complicated to be worth pursuing. When a group of fighters in Yemen fire a missile at a cargo ship carrying electronics from China to Rotterdam, how does that cost end up on your next electricity bill? How does it show up in the price of coffee or a pair of shoes? What is the mechanism? How does violence in a place most people can't find on a map become inflation in places that never heard a shot? The real story begins long before the missile is even launched. And it starts in a room most people have never heard of, in a market that quietly underpins the movement of everything you own. To understand this, we need to go back to how global shipping actually works. About 80% of everything physical that gets traded between countries travels on a ship. That is not a rough estimate. The clothes on your back, the phone in your hand, the coffee you drank this morning, all of it moved on a vessel. The steel in the building where you work, the lithium in your electric car, and every single one of those vessels carries insurance. Insurance in global shipping is not like car insurance. It is a layered, specialist market with its own institutions. At the base of it sits what are called protection and indemnity clubs, or P&I clubs. These are mutual associations. On top of that sits hull insurance, which covers the physical vessel itself. And above all of that sits war risk insurance. In peacetime, war risk insurance costs almost nothing. Before the conflict in Gaza erupted in October 2023, the additional war risk premium for a vessel transiting the Red Sea was approximately 0.05% of the ship's hull value. For a ship worth $100 million, that is a rounding error, about $50,000. Not cheap, but not meaningful. Then everything changed, and it changed in a matter of weeks. In November 2023, Yemen-based Houthi forces began attacking commercial ships in the Red Sea. By mid-January 2024, the premium had climbed from 0.05% to 1%. That is a 20-fold increase. A ship valued at $100 million now cost $1 million in war risk insurance for a single 7-day transit. The industry calls this an additional war risk premium. The acronym is AWRP. And the Red Sea, the Gulf of Aden, and the Bab el-Mandeb Strait were all placed on the list at the same time. Here's where the mechanism starts to move, because that premium does not just sit with the insurer, it has to go somewhere. And the path it takes is a chain that leads one link at a time, directly to households on the other side of the planet. The ship owner pays the war risk premium to the insurer, that is step one, but ship owners do not absorb that cost. They pass it directly to the charterer. The charterer is the company that has hired the vessel to carry specific cargo on a specific voyage. It might be a major retailer, a commodity trading house, or an energy company. In most spot freight contracts, additional war risk premiums are, by market convention, on the charterer's account. That is just how shipping contracts work. The charterer pays, but the charterer does not absorb it either. They pass it on to the importer or the buyer of the cargo. The importer, in turn, adds it to their cost basis. And because most importers are not in the business of eating margin losses, they pass the cost to the retailer or the distributor or the wholesaler in the supply chain below them. The retailer raises prices. The consumer pays more. That is the chain. Insurer to ship owner to charterer to importer to distributor to retailer to household. 6 links, every single one passing the same cost forward, each adding a small margin on top for the disruption and uncertainty of managing it. The IMF published research on exactly this mechanism and found that when global shipping costs double, headline consumer price inflation increases by 0.7 percentage points. That may sound modest, but 0.7 points across an entire economy is an enormous amount of money. In an economy the size of the United States or the EU, that translates to billions of dollars in higher household expenditure every year. And the IMF found that the inflationary impact of shipping disruptions is more persistent than oil price shocks. When oil prices spike, they tend to correct within months. Shipping cost increases get absorbed into retail prices slowly and tend to stay embedded longer. JP Morgan Research put a more specific number on the Red Sea crisis in early 2024. Their estimate was that the disruption could add 0.7 percentage points to global core goods inflation in the first half of the year. Core goods inflation. That is not headline numbers inflated by fuel. That is the price of physical objects. Clothes, electronics, furniture, all of it. Now here is where the story gets a second layer. Because the war risk premium is not the only cost moving through that chain. It just triggers a cascade of other costs that pile on top of it. The moment war risk premiums made the Red Sea too expensive to transit, shipping companies started making a different calculation. Container ship transits through the Suez Canal fell by 90% between December 2023 and March 2024. 90%. In the space of 3 months, one of the most important commercial shipping corridors on Earth had effectively shut down. And the ships did not stop moving. They took a different route. They went around. The Cape of Good Hope route around the southern tip of Africa adds approximately 11,000 nautical miles to an Asia to Europe voyage. It adds between 10 and 14 additional days at sea. According to LSEG Shipping Research, rerouting a mid-sized tanker from Asia to Europe via the Cape adds nearly $1 million in fuel costs alone. Not total costs, fuel alone. A full container vessel from China to Germany faces additional costs of $200 to $400 per container. Multiply that across a ship carrying thousands of containers and the mathematics become enormous. Fuel tanker day rates from the Middle East to the Netherlands went from $23,000 per day in December to $73,000 by late January. The cost to ship a 40-foot container from Shanghai to Genoa went from $1,400 to over $6,300 in just 2 months. Shanghai Containerized Freight Index data for 2024 averaged 2,496 points, which was 149% higher than the previous average. And because those costs have nothing to do with supply and demand for the goods, they are experienced as pure cost-push inflation. The shoes cost more, not because there are fewer shoes. They cost more because the box they came in on cost 6 times more to ship. Here is the jaw-drop moment. And it is something that virtually nobody talks about in news coverage of the conflict. The Houthis were not trying to cause inflation in Germany or raise prices in British supermarkets. That was never the stated goal. Their stated goal was to pressure Israel and its allies over the war in Gaza. But by attacking commercial shipping in the Red Sea, they had accidentally discovered one of the most cost-effective instruments of economic disruption in modern history. And they had done it without sinking a single major vessel at the peak of the crisis. Think about the numbers. The Russell Group estimated that goods worth approximately $1 trillion were disrupted by Houthi attacks. Egypt, which depends on Suez Canal tolls, saw canal revenues drop by more than 50% in 2024. One country's national budget materially damaged as a side effect of a conflict it was not party to. Port of Eilat, Israel's only Red Sea port, reported an 85% drop in shipping activity and eventually halted operations entirely. The port was strangled not by a blockade in the traditional sense, but by insurance math. Nobody wanted to pay the premium to get there. Tesla announced it was suspending production at its Grünheide factory in Germany for 2 weeks because of supply chain disruptions. Not because a bomb fell anywhere near Germany, because the parts that factory needed were on ships taking an extra 2 weeks to arrive. Volvo Cars halted production at its Ghent plant for the same reason. The economic blast radius had reached the factory floors of Europe. Now we need to talk about what this means. The mechanism from insurer to ship owner to importer is not a malfunction. It is the system. It is the efficient transfer of risk. And it creates a vulnerability that is almost impossible to fix without restructuring global trade. War risk insurance premiums do not just respond to actual attacks. They respond to the probability of attacks and geopolitical rhetoric. And when Iran issued a threat to close the Strait of Hormuz, insurance premiums for Gulf transits spiked before a single attack occurred. When Ukrainian drones targeted Russian vessels, Black Sea war risk premiums surged 250% in just a few weeks. The insurance market is constantly pricing the probability of disruption. It is globally interconnected and highly sensitive. Any credible signal of conflict immediately transmits cost increases to the entire global supply chain downstream. It does not matter where you live. If your country imports things by sea, you are exposed to this mechanism. The more trade-dependent your economy is, the more exposed you are. Island states feel this twice as hard as self-sufficient countries. The inflation in your wallet is not labeled. It is baked into the cost structure of everything that moved through a disrupted shipping lane. The IMF found that the full inflationary impact of a shipping cost shock peaks after about 12 months. Oil price shocks peak in 2 months and fade. Shipping cost shocks take a year to fully transmit and then persist. The cost was traveling through the supply chain the whole time, slowly, invisibly, without a label. And here's the second twist. War risk insurance was created to protect ships, but it transmits conflict to countries entirely at peace. A group of fighters fires a missile at a cargo ship, and the cost arrives on the other side of the planet on supermarket shelves. The most expensive thing about modern conflict is not always the weapons. Sometimes it is the insurance on the ships trying to go around them. Every household paying higher prices without knowing why is, in a quiet financial sense, already paying a war tax. They just never got the bill. This is not just a story about shipping. It is a story about the architecture of the modern global economy. In a globally connected economy, there is no such thing as a war that stays contained in one place. The financial shockwaves travel with the cargo, and we are all downstream. But this doesn't stop at insurance, because once those costs enter the system, they spread. If you enjoyed this deep dive, share the video and subscribe. In the next video, we break down how these ripples move through freight markets. Click the video on your screen now. This is where the chain reaction begins. Thanks for watching.